Start with Netflix today for our calls because they got another one. The stock's been unbelievable. Reiterated by UBS. I think you know all of the reasons why people continue to like this name, UBS included. Jason, you own it. They did break the 11-day win streak yesterday. Yeah. But it has been the best performing comm services stock year to date and over the last 1 year.
There's no doubt about it, Scott. I mean, you see the price action, the stock's up 28% year to date. The EPS growth is over 25%, rev growth is above 12%, and I think to the points earlier, it has proven to be a safe haven in this market, and I think that's what's been positive. The optionality from premium to ad-supported tier, there's a lot of spread there, and I think that's why people like the stock.
What about ServiceNow, reiterated by BofA? That's yours, too. I should also mention that Bill McDermott and Jensen Huang are going to be with John Ford today on Power Lunch together, so you don't want to miss that. About 2:30 Eastern. That's from their ServiceNow's annual knowledge conference. So it's a big interview coming up. But what about this stock?
They had a really strong report. Let me say that 19% EPS growth, 18% revenue growth. I think the concern coming into the print was their government business, which is continuing to grow given all the changes that this administration has made. They're still growing there, so I think that's why the stock is bumped nicely.
Bryn, what about Diamondback, which beat today?
Yeah, I mean, they're the best operator in the Permian. I will say, Travis Stice, the CEO, says, at these prices, it just doesn't work. And I think you also see the rig count is down. Oil to pull oil out of the ground is becoming more expensive. And so technically all these stocks look the same. They're making lower highs and lower lows. So you just have to have that settle out. Trump's been clear. He wants energy prices down. OPEC wants more production. So it's really a perfect storm where these names have just been under pressure and probably will be for the rest of the year.
Let's look at Marriott before we take a break here. They cut their full-year guide by 50 bips due to a more cautious outlook, they say, in their U.S. and Canadian regions. Stock's positive, though. And that's interesting to note. Jenny, you own that name?
Well, I think we've been talking a lot about expectations versus reality, and expectations were probably for a worse cut given how much uncertainty there is. But here's the thing on Marriott. What I like about this is it reminds you that there's still things to do, even in a very uncertain environment. We've owned this since 2013. It's got a 9% annualized return. The earnings growth ahead is totally decent. It's 8%, 13%, 12% for the next few years ahead. It trades at a little bit higher than a market multiple. This is something you can own for a long time. You don't need to worry about the next year. You worry about the next 5 years.
Okay, up at 1.25 today.